Last week was huge for earnings. Market movers included Facebook, Amazon, and Comcast. And this week shaping up to be just as dramatic, with Apple, Boeing, Tesla, and others on the docket. Joining us now with an earnings scorecard is Mike Thompson, president of S&P Investment Advisory Service. Good morning.
Morning.
We're on good pace. Yeah, more than 80% are beating on the EPS. That obviously was expected. But how would you sum up the season thus far?
Oh, it's sizzling hot. I mean, we're at 23.5% so far for the quarter, and it's going to probably go a bit higher. It's hard to find bad news in this, utilities and real estate, but across the board, look, technology is strong, 26%, financials strong, 26%. When I look at consumer discretionary at 17%, and the next couple of quarters coming in high, growth rates in the high teens. This is good news. I'm going to say a couple of things. One, I'd say about 25 to 30% of these earnings are against weaker comps because, we have the tax reform. Okay, so I think the challenges are when you get to the hard comps next year in 2019, if you want to look that far out. But right now, you can ride the next couple of quarters and feel pretty good about it.
What about the commentary that's, beneath the numbers?
Yeah, so, it's really interesting. At S&P, we've actually deployed some interesting artificial intelligence, and we're looking at positive to negative commentary, and basically we have a ratio there, and that number is very strong. In fact, we're going through the transcripts, and usually that has pretty good efficacy of how, the companies are expected to perform. It's been looked at over many, many years. And right now we're at the second highest reading in 10 years. So last quarter was the best, of course. The
ratio of positive to negative.
That's
commentary.
right.
I mean, even with all the trade stuff that's out there.
And actually divided by total number of, the words they use. So it's actually the whole body of research, and it's AI. It's kind of interesting stuff. What it does, it gives you some confirmation, and you look at it as a new trend. So it's pretty good. And again, part of that is backward looking, part of it is forward looking, but it's good stuff.
There's disparity within the sectors, right, that are pretty dramatic. Energy going to be up combined for 2018, 145% when it comes to earnings. And then there's, real estate, which is going to be up only 2%. I mean, do we see performance related to that and the underlying? It's not my sense that we do.
Not really. Well, look, here's the deal. I mean, let's just take it back to the valuation conversation. I'm really comfortable at 17 times, which is where we are right now. Okay, this market's been trading at 16 to 17.5. At 17.5, this market, and this is the way the market's been behaving for the last couple of years. Any kind of disturbance, dislocation, bad commentary, trade war, anything like that, market goes and takes a hit. 17, not too bad. So the real question is this. Look, next year, earnings are going to get tough based on comps, right? However, what you don't have in today's estimates for 2019 is, a better growth forecast for GDP. Right now, growth forecasts for 2019 are still in the 2s. So if you get 3s, it's a mitigating factor, but who will know?
Mnuchin, Treasury Secretary, says 4 to 5 years of 3+%. That would support valuations remaining
indeed
pretty good.
And then again, it's back to the one other question, which is what's the U.S. Treasury 10-year going to do?
Yeah,
in interest rates?
Of course. All right, thanks. Good to see you.